Morgan, Adam, thanks for being here today. Really appreciate you taking time out of your schedule. We're here to talk a little bit more about yield optimization and how we're solving that problem within the walls of State Street for our clients, both from a financing solutions perspective, also from a technology perspective. So Adam, I'm going to start with you. Obviously, living in the world of GlobalLink, we have a slew of products that are in there. How have you been discussing yield optimization with clients in light of the recent market trends that have happened?
So for us and our clients, a lot of it just comes down to your cash pooling. You've got different sets of cash in terms of how you're going to be investing it. Obviously, you've got your daily liquidity stuff, and you're going to be able to earn a certain yield on that. But as you can kind of go out larger, a little bit longer on the spectrum in duration, you can pick up a little bit of additional yield from that space. In terms of rates, right? So rates as a whole, we've been very steady. It's looking like the prevailing thought's going to be, we're going to be consistent mid-2024. Then on the tail end, we'll start to see that decrease. Money market funds as a whole have been up, this year. Some of it is driven because of that yield. There's also been a couple market events, right? Early 2023, we had the First Republic, we had the Silicon Valley Bank. So some of these clients started to realize we're in this single bank exposure, on the deposit, on their balance sheet, and maybe we want to get out of that and go into a mutual fund. This way here, it'll help diversify the risk from that perspective. So just in terms of, getting from that yield space, going out the longer duration, as we do see rates start to decline, you're going to be able to pick up yield on the money market funds a little bit longer because they will go out in duration in the fund.
Great. Well, thanks very much. It's very insightful. It's good to hear, we have those solutions in place to help clients be nimble when they need to move around to different investing solutions. Pivoting just a little bit, Morgan, maybe you want to talk about from the financing solution perspective. Obviously, you're very active in the repo market. Maybe just talk about a bit what you're seeing with your client interactions.
Yeah, for sure. So obviously up until March 2022, we were in a zero rate environment for two years. We've had 11 hikes since then, and we're just seeing so much cash flood into the repo markets from then to now. So for years, those 2 years, the RRP, the Fed's reverse repo facility, was getting a ton of cash, especially from the money market fund community. So right now, interdealer repo, due to bill issuance and other market conditions, is trading solidly above the RRP. So we're seeing a ton of cash come into our fixed sponsored member program specifically from those money market funds because we can pay a yield above that RRP. So repo as a whole, just given the fact that money managers are managing every single dollar to the cent, has become a much more attractive investment than it was 2 years ago as these rates continue to be pervasively rising month over month. So given everything going on, we do see some clients terming out a bit, but otherwise most clients, 99% of our book are in the short end, keeping it overnight. And obviously we'll keep an eye on things with the Fed hiking and cutting, et cetera, but that's really what we're seeing today. Just some key considerations underlying that. Our clients are looking at optionality across the board. Who can they face off with from a counterparty perspective, whether that's counterparty risk or counterparty diversification? They want to see it all. Is it going to be an active investment? Is it going to be a passive investment? Are they going to manage, again, that dollar at 7 a.m. and decide where that's going on every single day? Or are they going to do a passive sweep, whether that be into a sponsored repo program, a money market fund, on balance sheet? Clients are trying to get as much capacity as they can, especially over crunch periods, and we're seeing that time and time again, just given everything going on in the market.
So it seems like we're very well positioned from a financing solution perspective, right? We have different ways that clients can access liquidity depending on what their requirements are. Do you find like you're having a lot of conversations with the clients that are more thought leadership or more consultative in manner?
We're definitely getting a lot of questions, I think, especially with certain SEC guidelines that are potentially coming down the pike. We're seeing clients ask, how is that going to impact them if they're not clearing repo today? Do they need to clear repo? Does it need to go into a peer structure? Just seeing where that is. Our sponsored book is quite large at this point, and given the flood of cash into sponsored repo and out of the Fed's RRP, they're asking, do we expect that to continue? Do we expect rates to stay elevated? What are we seeing in terms? So it's definitely just an ongoing dialogue with clients, and candidly, it's been awesome to see, especially going from zero rates up now. There's just so much more active dialogue in the market.
No, that's great to hear. It seems like we're obviously very well positioned with the size and scale that we're able to offer out to our clients. Adam, I'm going to pivot back over to you just for a second here. a lot of those alternatives that Morgan was talking about, we're able to offer them through the GlobalLink suite, like a Venturi. We obviously have the Fund Connect product that was homegrown as well. Maybe you want to talk just a bit more about the technology offerings that we're able to deliver to our clients to have them access to liquidity when they need it.
Yeah, so a big component right now within our clients is straight through processing. And that means a couple different things to different clients based off of where they are on the technology spectrum. You have your very sophisticated clients that are using OMSs and TMSs to kind of drive trade input. And what they're looking to do is, maybe use an API, have a single point of reference, but really have it feed to all of their downstream systems so that they can pick up efficiencies in terms of less duplication of effort or duplication of processes. Within that, we offer solutions that allow you to interact with those systems and then go into a full suite of products. In terms of money market funds, it comes down to your cash availability number. Whether you're trying to aggregate that through a couple accounts or if you're trying to do it through prime brokerages and multiple custodial accounts or other operating accounts. You get that number and you want to filter it through and essentially layer that into your investment process. We can take that number, whether it's input or fed to us from a system, and we can go and waterfall investments based off of a multitude of characteristics. And you can do percentages and really maximize your yield depending on what it is that you're looking to do within the comfort of your risk appetite and structure.
No, it's great that we're able to have something so nimble that we can offer out to clients, especially when certain market conditions tend to happen, or certain like the regional bank crisis that we saw earlier this year. Clients needed to pivot really quickly to be able to access different pockets of liquidity or move their cash from one place to another. So it's great to hear what we're able to offer in that domain. So I'm going to pivot back now to Morgan. Maybe you can talk a little bit what the conversations have been with clients about how they can optimize the yields, especially during periods of heightened volatility.
So what we hear time and time again from clients in periods of heightened market volatility are an insane focus on both stability and flexibility. So clients are really hammering home on capacity over crunch periods, whether that be a month, a quarter, a year end. Dealers have a tendency to close off their balance sheets. And what we can do in both the sponsored repo space as well as in the peer repo space is bubble up our balances and allow for inflows, outflows, really any sort of variety in flows. We can take that in. So thankfully, repo tends to run counter-cyclically to volatility. So when we see big swings in the market or, for example, the banking crisis, things we've seen in recent times, we see clients pivot to repo as they know it's a stable outlet. So we have about 150 clients in our sponsored repo program today, and they can put US dollar cash, US treasuries to work in over a month, a quarter, year end. As I mentioned, those crunch periods, as we call them in the repo space, we're able to absorb that into the program because all of that activity is netted and it's off balance sheet. So also in our peer-to-peer program, similar idea. It's buy-side participants teaming up together to finance, whether it be U.S. Treasuries, agency mortgage-backed securities, or investment-grade corporates versus that USD cash. We're seeing clients who, again, at those time periods where they might get closed off a dealer's balance sheet, the buy-side firms can come together, trade off against each other in an indemnified nature, and get that additional liquidity that they're looking for.
Well, that's great to hear. I mean, it seems like across the board, whether we're talking about products that we're able to offer from a technology perspective or products we can offer from a financing solution perspective, our clients are well positioned with us to be able to use the products in the various capacity, no matter what's happening in the market, whether things are going really well and rates are going in the right direction, or whether things are going poorly and they need to make a quick pivot. So I really appreciate you both taking the time today. It's been a pleasure to speak with you both, so thanks very much.